Hey everyone, let's dive right into this explainer and unravel the fascinating mystery of Meta's massive new pivot to cloud computing. We're looking at a move that has simultaneously delighted some investors and completely terrified others. It's a story of billions of dollars, immense computing power, and a sudden strategic shift that has the entire tech world on edge.
So, right off the bat, we've got to ask ourselves how a single announcement from Mark Zuckerberg about selling excess AI compute capacity sent shockwaves through the entire semiconductor supply chain overnight. How exactly does a social media giant deciding to rent out some server space cause multi-billion-dollar hardware companies to just nosedive in a matter of hours? Well, what's really wild here is the massive paradox in how the market reacted. On one side, Wall Street essentially threw a party for Meta, sending its stock surging nearly 9% to its best day in almost 6 months. But on the flip side, they aggressively dumped shares of hardware makers and neocloud operators who saw double-digit plummets. It's a complete divergence, and we're going to find out why. Section 1. The $145 billion AI gamble. To wrap our heads around this bizarre market reaction, we really need to look at the sheer mind-boggling scale of Meta's AI infrastructure. We're not talking about a few racks of servers in a basement. By the end of 2026, Meta's total on-hand power capacity for AI could hit around 5 gigawatts. 5 gigawatts! To put that crazy number into perspective, you're looking at enough electricity to power millions of homes, just for their AI. And the hardware side? Just as staggering. By the end of 2025, Meta's projected to hold the computing equivalent of 2.5 million highly coveted H100 GPUs. They've been buying up everything, GPUs, networking gear, cooling infrastructure, at an absolutely unprecedented rate. So you can probably see why Wall Street was getting super nervous. Meta shocked everyone by raising their capital expenditure guidance for 2026 to somewhere between $125 billion and $145 billion. Investors were looking at that astronomical spending and thinking, wait, how does this ever pay off? There was real heavy doubt if they could ever see a return on investment just by tweaking the algorithms on Facebook and Instagram. Section 2. Meta versus big tech rivals. Because look, while everyone in Silicon Valley is throwing money at AI, they aren't all doing it with the same safety net. If you compare the big players, a really clear pattern emerges. Alphabet, Amazon, Microsoft, they all have these built-in financial buffers. They've got massive existing enterprise cloud businesses or huge equity stakes in frontier AI startups. Meta, they don't have those buffers. Right now, they mostly just have the massive costs. I mean, the numbers speak for themselves. Google and Amazon are actively raking in cash from this AI boom right now through surging cloud sales and huge startup valuation gains. Meta, on the other hand, has basically been entirely dependent on future ad revenue to justify spending tens of billions of dollars. They literally haven't had a direct way to monetize external enterprise AI demand. Section 3. The Marathon Water Seller. And this brings us to Meta's pretty ingenious solution to their multi-billion-dollar problem. What do you do when you have millions of GPUs and can't use them all perfectly yet? You monetize what you have too much of. I absolutely love this analogy from the reporting. It's like an AI marathon. Meta was sprinting super hard, realized they might be falling behind the absolute leaders, so they did something smart. They sat down by the side of the road and started selling water to the other runners. They shifted from just burning cash in an arms race to becoming a highly rational hash rate seller. Now, they aren't trying to build a full-blown cloud platform overnight. They aren't trying to be AWS or Azure with all the complicated databases and developer tools. Instead, analysts think their best move is selling what's called bare metal compute. Essentially, this means renting out the raw, incredibly powerful engine directly to buyers without making them buy the whole car. Since Meta already has world-class networking and hyperscale economics, they can just hand over access to that raw compute. So the playbook is basically twofold. First, sell access to hosted AI models on Meta's infrastructure, or second, just rent that raw, bare metal capacity straight to competing neoclouds. It's a total game changer. They transform underutilized, sunk-cost hardware into a totally viable cloud service. Financial analysts are calling this a margin of safety. And if you know anything about investing, finding a margin of safety is exactly how you turn a terrifying gamble into a calculated, smart strategy. Section 4. The chip stock crash. Okay, let's circle back to that massive market paradox we mentioned earlier. While Meta's pivot was fantastic news for Zuck and his investors, it sent an absolutely terrifying signal to the hardware supply chain. I mean, look at these single-day drops.
If Meta, literally the world's most aggressive buyer of AI chips for the last 2 years, suddenly comes out and says, hey, we actually have so much compute we need to start running it out, investors instantly panicked. The immediate thought was, wait, did we just hit the ceiling on AI hardware demand? This sudden, gripping fear of order cancellations and market-wide excess capacity is exactly why giants like Micron, Corning, and neoclouds like CoreWeave took such huge hits. The logic makes sense, right? If Meta bought too much, maybe everyone bought too much. Maybe this massive, full-speed-ahead arms race is finally hitting the brakes.
Section 5, Bear versus Bull debate.
So right now, there is a fierce, two-sided debate raging on Wall Street over what this all actually means. The bears are looking at this and seeing a giant red signal flare. They think this proves there's excess capacity, which will inevitably lead to slowing orders and a dead narrative for the hardware boom. But the bulls? They see the exact opposite. They argue that by recovering these costs, Meta is actually building a sustainable business model that will let them buy even more equipment down the line, creating this powerful, positive feedback loop. And Meta's massive stock surge really proves where the money is leaning. Capital is rewarding the shift away from an unlimited arms race toward actual commercial rationality. Investors don't necessarily care about the immediate rental profits, which might only be a drop in the bucket. What they really care about is that management is finally prioritizing capital efficiency. Section 6, the looming black swan. But here's the thing, the real threat to the market might not be Meta's actions alone. The true black swan event that has the industry holding its breath is what happens next. The big question is, will other hyperscalers like Microsoft and Amazon succumb to capital pressure and cut their own CapEx plans? If they follow Meta's lead and start prioritizing rational investments over limitless expansion, we're looking at a total reassessment of AI hardware values across the board. So moving forward, we absolutely have to watch for a few specific things. We need to keep a really close eye on shifts in Amazon AWS CapEx guidance, and we need to monitor Microsoft Azure's infrastructure spending limits. Because, let's be real, if there are coordinated cuts among these absolute giants, it would shake the entire foundation of the AI supply chain. The story of AI hardware is definitely not over, but the script is literally being rewritten as we speak. As AI infrastructure requires more and more utility-scale planning and massive debt financing, the era of spending without limits is officially over. We're transitioning to a phase where growth actually has to make commercial sense. So, I want to leave you with this final thought to chew on as we wrap up this explainer. Are we witnessing the first domino falling in an AI hardware market crash? Or is Meta just the pioneer of a new, much more sustainable tech economy? It's kind of like the painful growing pains of an industry finally learning to walk. Keep a close eye on those other big cloud providers, because their next move is going to answer that question for us all. Thanks for exploring this with me today.